Welcome. I'm Nicole Cervi, and I'm joined here today by my colleague Tim Quinlan to discuss our latest monthly economic outlook. So Tim, before I kick it to you, let me just start by summarizing some of the data that we've seen over these past few weeks. So the most important print that I think we've seen in terms of the 10,000 feet view of how the economy is faring is we got to look at real GDP growth in the first quarter. What we saw is that the economy contracted slightly in the first quarter, but if we look at the underlying details, pretty much all of that contraction stemmed from net exports. And so if we think about GDP and how it's calculated, we're trying to get a look at how much we're producing domestically. And what we saw was a historic surge of imports as businesses and consumers were looking to front run these tariffs, and the surge in imports really punishes gross domestic product growth. If we look at the underlying demand components of GDP, so consumer spending, household consumption, business fixed investment, those components were actually quite solid. They continue to expand over the quarter at rates pretty similar that they've been expanding over the past few quarters. And so when we see that the underlying strength or the underlying demand of the economy continued to hold up in the first quarter, even though we saw a contraction, that actually helped non-farm payroll growth to actually continue to be better than expected in April. You see over these past 3 months, non-farm payrolls are expanding at around 150,000 jobs added per month, and the unemployment rate's largely been stable at 4.2%. And so what we're seeing is that as demand continues to expand at its run rate, it's allowing the labor market to continue to expand, albeit at some lower rates, but we're seeing a stabilization there. And with employment still rising, you're seeing that wages are still increasing. And so that's helping your household sector in terms of their personal income growth. That's still solid. And what we've seen there is that even as you've seen a little bit of weakening in terms of the pace of employment growth, we're still seeing wage growth that's positive. And if consumers are still receiving their income, they're likely to spend, and that's helping these underlying demand components continue to expand in the first quarter. What I'll say, though, is although we've had this decent run of data, this still largely predates the bite from tariff policy changes that we've seen over these past few months. So, Tim, now that we know that the underlying strength of the economy is still intact, how do tariffs kind of change the outlook from here? What's our expectation on trade policy in the next year or so?
Right, well, we've had a big step down in terms of where we are with our trading partners, specifically in the latest stay of execution that we've had with China. Now, we don't have a permanent deal inked with China. That should be stressed here. But for the next 90 days, we've rolled back or put a temporary pause on the triple-digit reciprocal tariffs that had been in place, and down to a 10% baseline plus 20% additional for fentanyl kind of penalties here. But I think what you're beginning to see emerge in some of these bilateral trade negotiations, Nicole, is kind of a 10% universal baseline tariff is the new table stakes for any deal with the United States. So on that basis, a return to the 3.2% effective tariff rate that was in place last year doesn't seem like a super reasonable expectation in our view, but at the same time, holding it north of 20% where they were prior to this negotiation with China probably doesn't seem all that reasonable either. So for the purposes of our forecast, we expect an effective tariff rate of about 15% to be the kind of baseline expectation from now through until the end of next year.
Okay, got it. And it seems that some of these changes that we've seen in tariff policy, especially with respect to China and the United Kingdom, is inching us closer to that effective tariff rate assumption of 15%. And so now that we've started to see some relief, so as you mentioned, Tim, we were north of 20% before some of these deals came out. Now we're closer to 15%. Now that we've seen some relief on tariff policy, how does this help the labor market, or where is the labor market going to fare from here on?
Yeah, well, as you mentioned, we've kind of gotten to this steady state growth, about 150,000 jobs or so a month. The April outturn was certainly better than what was a very low expectation. And I guess I'd point out that the survey week includes the week that includes the 12th. So it may be a bit early to declare a victory over all of the trade disruption and the jobs data. but we haven't really seen a big mounting in initial jobless claims yet either. So largely what you've seen in terms of this moderation in the pace of job growth is a slowing in the rate of hiring, but not yet a big increase in the pace of layoffs. And we kind of have more of that in mind throughout the course of our forecast. Yes, the unemployment rate does rise, but only incrementally so, a few tenths of a percentage point. And yes, non-farm payroll growth goes negative, but only for a few months. We're not looking for a big complete fallout in the pace of job growth. So on that basis, we think it's more or less reasonable to expect continued deterioration in the labor market, but helpfully not enough to slow the underlying wage growth that will be the driver behind sustained consumer spending.
Got it. Yeah. So if we still have wage growth that's positive, even if we're seeing some contraction, and some of that might be related to the Doge effect in Washington, D.C., if we still see, though, household sectors still enjoying some real purchasing power gains from income growth staying positive, that implies to me that you're still going to see consumer spending at least modestly positive, maybe not completely falling out of bed. So in that instance, maybe we're seeing stronger demand growth, which would put some upward pressure on inflation theoretically, especially if we have stronger demand, at the same time that we have tariffs putting some upward pressure on input costs, right? So we haven't seen tariffs go back down to sub 3% like we had previously. We're still likely going to see it closer to 15%. And so businesses are going to have to adjust their prices accordingly to make sure that margins are not squeezed unduly. So Tim, turning it back to you, what's your expectation for inflation this year, and how does the Fed respond to this situation?
Yeah, well, tariffs are going to eventually stoke inflation. That's kind of the underlying message. Now, it doesn't have to be a one-for-one pass-through effect, and it doesn't have to happen immediately. And as you pointed out in your recap of first quarter GDP, we had this big pull forward in imports. And that means that firms are sitting on really high levels of inventories today. When they have to pass on those prices, they don't have to immediately pass on the tariffs impact, especially to the extent that they can rely on those built up inventories. Now, that doesn't last forever. And at some point, you have to eventually pass on those tariff costs. And by the time that happens, we expect the fullest manifestation of that to occur by the fourth quarter of this year. At that point, our year-over-year core PCE forecast comes in at about 3.3%. That's roughly about half a percentage point higher than it was in the first quarter of this year when we were at about 2.8%. So yeah, that's above target for policymakers at the Fed. Now, what's challenging for them is to view this rise in prices against the backdrop of admittedly a deterioration in the labor market. And our bet is that they look through these short-term tariff-driven increases in prices and prioritize the deterioration in the labor market. Now, since this deterioration is happening so slowly, there's no urgency to act right away. Our guess is the first rate cut doesn't come till September with a 50 basis point cut. Two more smaller 25 basis point cuts at the October and December meetings will give you a full percentage point lowering in short-term interest rates by year end. At that point, you've got what we expect to be a little bit of positive developments in the way of fiscal policy taking place by early 2026. And that, in tandem with the lower borrowing costs and lower Fed funds rate, ought to be supportive of a somewhat faster pace of growth in 2026.
So it sounds like, just to quickly summarize, we're going to see some short-term pain in terms of sluggish GDP growth in 2025, but come 2026, as monetary and fiscal policy become a little bit more accommodative, we'll see growth start to rebound. So thank you, Tim, and from all of us at Wells Fargo, thanks for tuning in to our latest monthly economic outlook.